Welcome back, everyone, to day 15 of our journey to financial freedom. We are officially kicking off week 3, and after building our mental foundation, we're shifting gears to a fascinating new topic: stock market mechanics. Let's dive in. For the past 2 weeks, we've been all about building that psychological fortress, what we call your neuro fitness. Well, now it's time to take that mental strength and step into the arena to answer the big question: what truly moves a stock's price? We're about to look under the hood at the very engine that drives everything. For most people, and hey, maybe this is you right now, the stock market just looks like a screen of chaotic, random numbers jumping around. It can feel really unpredictable, maybe even a little intimidating. But here's the first and most crucial thing to understand. It is not random. Not at all. Every single price movement is governed by one simple yet incredibly powerful law: the law of supply and demand. This is the invisible engine behind it all. Okay, so you're telling me it's not just some giant casino where people get lucky or unlucky, basically just placing bets on red or black? Because that's a massive mental shift for a lot of people. That's exactly right, and it's the number one misconception we have to dismantle. This is not a game of chance, it's a system with very clear, very understandable rules. So the best way to visualize the stock market is to think of it as the world's largest, fastest auction house. This is an auction happening millions of times a second, all across the entire globe. And at its core, this whole giant auction is actually incredibly simple. It all boils down to just two forces. You have the bid, which is just the collective voice of all the buyers saying this is what we're willing to pay. And then on the other side, you have the ask. That's the voice of the sellers saying this is the price we'll accept. It's just a constant global negotiation. And that price you see flashing on your screen, it's simply the record of the last completed transaction. It's the last exact moment where a buyer's bid met a seller's ask and they both agreed. It's like a real-time map of human desire meeting scarcity. Okay, that makes perfect sense. The price is just an agreement. So what actually causes that point of agreement to move up or down all day long? That's an excellent question. Let's just walk through a scenario. Imagine a company announces a huge breakthrough product. The news hits. Suddenly, a wave of optimism sweeps in, and way more people want to own a piece of that company. Buyers rush in, but there are only so many shares to go around. So what happens? The buyers have to compete. They have to outbid each other, inching their offers higher to tempt someone to sell. That bidding war is exactly what drives the price up. Now let's flip it. Some unexpected bad news breaks out, a terrible earnings report or something. A wave of fear hits. Now sellers are desperate to get out, but there are very few people interested in buying into trouble. So the sellers are now competing with each other for the attention of those few buyers. To make a sale, they have to lower their asking price and then lower it again. And that is what drives the price down. So the crucial takeaway here is it's just a constant seesaw. The price is always moving toward the side that has more pressure. Either the enthusiastic pressure from all the buyers pushing it up, or the desperate pressure from all the sellers pushing it down. And this right here brilliantly illustrates why we spent 2 weeks on neurofitness. When you understand this simple auction mechanic, you can reframe those emotional headline-grabbing market events into just objective, observable facts. It's your shield against panic and euphoria. Exactly. So when the news is screaming market crash, your neurofitness kicks in. You can take a step back and see it for what it really is: a temporary imbalance where sellers are just in overwhelming control. Reacting emotionally to that label is what makes people sell at the bottom. Seeing the reality is what allows you to stay calm. And the same thing applies to a bubble. Instead of getting swept up in all the hype, you can objectively identify it as a period where demand, rational or not, has completely overwhelmed the available supply, pushing prices to levels that just aren't sustainable. This objective view is what keeps you from making that classic mistake of buying at the absolute peak. This is a profound shift in thinking. The amateur reacts emotionally to the price itself. The professional analyzes the underlying forces of the auction. They aren't asking why, which can lead you down an endless rabbit hole of stories. They're asking what. What is the state of the balance between buyers and sellers right now? And that brings us right to today's cognitive task. It's time to move from understanding the theory to actually training your eyes to see it happening in the real world. Your action plan is simple, but it is so powerful. Pick a company you know well, pull up its stock chart for the last 5 days, and here is the most important part. Completely ignore the money. Don't think about gains or losses. Instead, I want you to view that chart as a story, the history of a week-long auction. Pinpoint the uptrends and literally say, here the buyers were in control. Then find the downtrends and say, and here sellers took over. This isn't just an exercise. This is how you build true market intuition. You're training your brain to see the forces, not just the price. This framework completely demystifies why a price moves, but it naturally leads to the next big question, right? In this giant global auction, what are people actually bidding on? What even is a share? That is exactly what we are going to break down tomorrow. We'll see you on day 16.